Welcome, everybody. I'm Riccardo Tambara, a financial analyst at Portfolio 123, and I'm hosting from here in Milan, Italy, a special webinar series about stress testing. Stress testing is something that is a lot of time neglected when it comes to backtest. And as far as backtest, as you are probably aware, Portfolio 123 is one of the best platforms available. Once you have a nice backtest, a nice equity line, you may wonder if it can really translate in an actually successful investment strategy. And this is what we're going to talk about today. We are not going to go too much deeper into statistical tests and all sorts of advanced techniques in order to see how a strategy is solid, but we are mostly going through tips and tricks on how to use portfolio tools in order to see how much robust a strategy is. So without further ado, we will go directly into a ranking system, and then we are going to test both the strategy, both on screen and simulated strategy. And the first thing that I want to show you is that you don't have necessarily to trust the data that you see, because sometimes you can see something really awkward going on. So you want to make sure that the stocks that you are testing on are actually investable stocks. Now, this is a very extreme example. I had to cap a bit, in order to get this performance. But as you can imagine, these are stocks that you cannot really be investing in. In fact, I looked at extremely illiquid stocks, microcaps, uninvestable, and in order to give you a better idea, I'm going to go briefly into the rolling back test. We are going to talk about it in a minute. And as you can see here, we have stocks that at the start of the holding period are worth 0 or something like that. So the price return is totally off the charts, and you definitely want to avoid that. So always make sure to, if you are looking into microcaps or nanocaps, because for example, here we are looking at the entire US market, please make sure that you have on some type of liquidity rule and some type of price rule in order to avoid stocks that are totally uninvestable. So let's start with the ranking. So here I put a number of nodes on our ranking system on pretty standard investment factors, such as value, financial strength, volatility, etc. They are all custom rules, but you can also play around with different nodes. And as you can see, for now, I didn't do any optimization. Why? Because I think that extreme optimization of the weights or pools or whatever can lead some investors to overfitting. And so you want to make sure that in your investment strategy, especially if you are investing in just a few stocks, let's say portfolios of 10, 20, or 30 stocks, you definitely want to avoid over-optimization. So let's say that, for example, you are changing the value weight from 20% to 21%, and the strategy is totally going off. Of course, that is a clear sign of optimization. In order to check whether that's happening or not, we're going to use the performance tab of the ranking system. So here we are going to select the, let's start with the universe. Let's start with all fundamentals, and then we are going to also test different universes. And I'm going to select VTI benchmark, so all stocks. we're going to use the entire testing period, and well, let's put a more standard rebalance frequency of 1 month. So this is a pretty good result to start with, because in here we can see all the different buckets. So the top 5%, the next 5%, etc. And they are pretty well aligned apart from the very bottom. But then here, since we are using all the available stocks in the universe, apart from a small filter of $3 or less stocks that is by default in the performance tab, we can say that this strategy, which is a pretty wide range multi-factor strategy, is performing pretty well. But of course, we cannot stop here when testing a ranking system. So we want to make sure that this can also work in different environments. And probably the strategy is more heavy into small caps. So we are going, using the whole stocks universe. So we are going also to test it in large caps. And here I'm using not a market cap weighting benchmark, but an equal weight benchmark. And I think that this is more in line with our strategy, because here I remind you that we are testing equal weighting. So let's see how it goes. Okay, so in here we can see that the strategy is losing predicting power, because it's predicting pretty well which stocks are not performing well, but it's not really predicting much above, let's say, the first third of the universe. So this is just an early indicator that something can be not entirely right here. And so we are going to further divide the sample period. So in here, for the large caps, actually you can see that the top buckets are performing quite well, and there is a general tendency in the last 5 years of positive slope of the rank, but still the predicting power is not exactly stable. That may have something to do also with rebalance frequency that we are going to test in a minute, but are also looking at a different time frame, because of course want to really try to maximize how much how many all the angles that you can see this ranking system with the data that we have available. And so in particular in this period, and it was a period where stocks were going up a lot from the great financial crisis, this ranking system doesn't seem to have any real predicting power. Lastly, here, even here, we still don't see much of the very nice performance that we saw before. So we can already tell that it's not working very well for large caps. It's going to perform a bit better if we include also mid cap or small caps, and probably that's where we are going further in the test. But before, of course, you also want to test different rebalance frequency here, because some factors are going to show their predicting power over different time frames. And rebalance frequency, in my opinion, is one of those levers that you can put that it's a bit atypical because some factors are not going to show up in 1 week, 2 weeks, or even 4 weeks. I'm thinking about, for example, value. It's going to take a bit while longer for them to show up. So here, for example, even if we narrow it down to large and mid cap, it seems that there is a bit more of performance and predicting power. And maybe we're just going to test the problematic periods. Even here, we can see that it's proving a bit the the predicting power, especially on the left tail of the distribution, but not by very much. So even here, we can say that this stable ranking is not so stable after all. But still, it was showing a bit of predicting power, especially in the last few years, and it's something that you are striving for, especially in the to find some outperformance in the last few years. So we are going to give it a shot in a screen and see how it goes. So in here we are selecting the rank that I showed you before. We are going to select quite high number of stocks. We are going also to test with less stocks. In general, 30 stocks is kind of a sweet spot for diversification. Going too much below, it's going to definitely bring more instability to the strategy. So in here, we can see that the strategy is performing pretty well, especially in the last period, because here is going with a higher performance compared to the market, especially here, as you can see. And there is also outperformance in during the financial crisis, because most of the alpha is in here and in here, while it's probably going to have negative alpha in this part. But of course, we're not going to stop here, and so we are going also to select a different bucket. So compared to the rank performance test that we did before, we are going to try to select a different bucket. So let's say excluding the top 5%, and see if this performance is still not there. As we can see, this is not happening, and so probably this strategy is still doesn't have much stability. So cannot be sure that even if you are in the right ballpark of, say, top 20% and picking randomly stocks from there, there is some instability, and so this could lead to periods of negative performance out of sample when we are going to launch this strategy live. Anyway, the strategy is still showing recent outperformance, which, as I told you before, is something that it's very important to find in an investment strategy. So if we narrow it down to 5 years, we can still see something going on. And probably this is due to the fact that the strategy is exposed a lot to conservative balance sheets through the financial strength factor and also to the profitability factor, which are factors that behaved pretty well especially in the last 3 years. In here, we can also do other testing about, for example, just selecting small caps or other universes. I'm also of the opinion that it's important to also test the strategy in different markets. We do have Canadian markets in particular, so this is an idea to really see whether your strategy, for example, is just exposed to, let's say, tech industry, United States tech industry, and this is going to show up if you are testing in different markets, such as the Canadian one. So in here, we saw that this strategy is not really stable, but we are going to give it a final shot using our simulated strategy. Now I'm going to disable a few things in here. We're going to see in a second. Well, here something is definitely going on, because as we saw before in the screener, we didn't see any of these tremendous outperformance before. And something that you really have to pay attention to is the fact that simulated strategies and screener are working in a different way. In the simulated strategies, you have much more control on the actual portfolio, especially the sell rules, because the screener is just going to shuffle every single rebalance period all the stocks according to the buy rules, while here you also have sell rules, and we didn't put any in there. And one particular indicator that shows us that we are actually looking at something that it's not really there is turnover. Basically, there is no turnover here. The portfolio is just selling those stocks that are going out of the universe, but we definitely don't want that. In fact, in here, we ended up with Apple, Microsoft, Gilead, so stocks that stayed in the portfolio for such a long time that by blind luck, we happened with a very high performance stock. So this case, I think that turnover is your friend. And so right now we are testing something more similar to the screener. So we are going to sell stocks with when their rank is below 90%. So we are going to just hold for 6 months stocks with the top 10% of rank. Okay, now it's much more, it's much less optimized, and we can see how the strategy is going to really perform. The strategy probably is very specific to the very, very top of the stocks that we selected. And so for this reason, there could be some issue going on with if we are selecting lower ranking stocks, but we already saw that in the screener. So a few things that I want to highlight here are especially allocation. So are we betting too much on specific sectors? It seems so, because we are very heavy on tech and healthcare. So maybe we want also to test the rules in order to reduce the weight of specific sectors and the industries. And something else, you can also do further testing on the fly on, for example, including also other ranking into consideration. And let's see how it goes. Okay, now it seems that now we cannot really tell from here, we don't have too much time, whether it was the sector weight that kept the strategy still stable, or if the core sentiment rating is improving the predicting power of the other ranking, which is, by the way, not including sentiment. But still, we saw that in here there is a nice outperformance in the last years, and in general a bit of reduced risk during a down market, as you can see here and here. While in up market, the strategy is relatively performing less poorly. And as you can see here, turnover, which tells you how often in 1 year the portfolio turns. So on average, 90% of the portfolio is not going to be the same in 1 year from now. Something very important that I left for the end is the fact that always I did a mistake in here. So best practice while backtesting is not to entirely use the entire testing period, because if we are looking at just in-sample data, of course, we are going to do some optimization. And so it pays to first test every single one of your strategies without using the entire period. You can, for example, take out 2 years, as I'm doing in it right now. Then you can save all of your tests in in different tabs and in different simulated strategies, and then compare just the out of sample performance of those strategies. This is going to make your strategy more robust and to show you, or at least to show you which ones tend to be a bit more shaky in returns or not. And there are, of course, more things that you can do, and I'm going to show you briefly a couple of tools that you can use to really optimize and to test the robustness of your strategies even more. These tools are just available for ultimate level subscription, but you can still do them manually on lower level subscription. So let's start with the optimizer. So in here, you can launch at the same time multiple simulation by tweaking different variables. So let's say that you want to test different cell rules. You can do that, and you can also see, for example, different periods in order to spot if there is any bias in the stocks that you are selecting first. So you can do this manually by creating 21 simulations, but in this way, of course, is much more easy. And what we are looking for here, especially when dissecting the strategy over different starting period, is to see where there is a very different equity line from one simulation to the other. From here, we can see that the strategy is not very sensitive to the cell rules, and I can tell you without having to wait for the entire set of combinations to run, that also the starting date is not impacting very much the strategy. Another thing that I want to show you is the rolling test. So here we are running the simulation for periods of 1 year, and adding another 1 year and seeing these 1 year periods, how they perform, how they compare to one another. So here you can see that there is so we are just looking at the last 10 years, and you can see that well, maybe let's try to bit more. Right. So the strategy here seems a bit more stable than predicted, but still, there are a number of years when the strategy is not performing. So let's say that 60% of the time the strategy here is outperforming, but there are a few times where even in entire years the strategy is underperforming. So you can expect that even if you launch the strategy live, is going to have years of underperformance, and that's a pretty high probability. See here. So one last thing before rapid Q&A. Right. So something that I showed you briefly was the rolling back test. Say last 10 years. So this is similar to the other tool that I showed you, strategy, but this works for screens. And in here you can see here in this case 6 months periods, okay, of screen. So the period is moving 1 month to the other. In total, we have 130 simulations in here of a 6 months period. And in here, you can see the stability of and test the stability of the excess return. General, of course, here. Okay, well, let's do the 5 years. So in here, you can see the average the average excess return, which should be positive, of course, for a strategy to be considered. And you can a very useful indicator is also to look at the standard deviation of excess return. You can easily download this to Excel spreadsheet, as pretty much every data on portfolio. And you can test whether different strategies have different standard deviation of excess return. And this is an excellent indicator of how much a strategy is stable. Of course, here you can, let's say that you want your results of your live portfolios over 3 months periods, you can test 3 month periods, or you can test any period that you like. Okay, this was all, and I hope that you found out something useful during this webinar. Thank you to everyone for your time, and I hope you have all a nice day.